Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Nike Inc. quarterly report. Nike Inc. offers a wide range of products and services across various categories. The company's product portfolio includes athletic and casual footwear, apparel, equipment, accessories, and services for men, women, and kids. Some of the notable products offered by Nike include: the company provides performance equipment and accessories such as bags, socks, sport balls, eyewear, timepieces, digital devices, bats, gloves, protective equipment, and other sports-related gear. Additionally, Nike offers various plastic products to other manufacturers. Nike also distributes and licenses casual sneakers, apparel, and accessories, as well as markets apparel with licensed college and professional team and league logos. The company's product offerings are categorized under several trademarks, including Nike, Jordan, Jumpman, Converse, Chuck Taylor, All-Star, One Star, Star Chevron, and Jack Purcell. In terms of services, Nike offers consumer experiences, including sport-focused events and activations, fitness and activity apps, sport, fitness, and wellness content, as well as digital services and features in retail stores. The company sells its products through various channels, including Nike-owned retail stores, independent distributors, licensees, sales representatives, and digital platforms. Overall, Nike's product and service offerings cater to a diverse range of customers, from athletes to casual wearers, making it one of the leading sportswear brands globally. Nike Inc. market capitalization of $65 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Nike Inc. holds a significant advantage in their industry. Nike Inc. trades at a higher price-to-earnings ratio of 29 times and a higher price-to-book ratio of 4.63 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 64% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. The company have a dividend yield of 3.72%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. The primary drivers of revenue growth or decline for Nike can be summarized into several key points. On the growth side, higher revenues in North America and Asia Pacific and Latin America, APLA, contributed to overall growth. Additionally, wholesale revenues increased 11% due to expanded distribution and marketplace management actions. Apparel revenues also saw a significant increase of 5% on a currency-neutral basis. However, there are also several drivers of revenue decline. Nike Direct revenues decreased 6% due to declines in digital sales and store sales. Converse is undergoing a strategic reset, which may have a negative impact on revenues in the short term. APLA revenues also declined 2% on a currency-neutral basis, primarily due to lower revenues in Japan and Korea, as well as Southeast Asia and India. In terms of specific product categories, footwear unit sales increased 8%, but were offset by lower ASP per pair, resulting in a decline of approximately 3 percentage points. Converse revenue declined across all territories, with unit sales decreasing 37% and wholesale revenue decreasing 35%. Overall, these factors highlight the complexities of Nike's revenue growth and decline and demonstrate the need for continued strategic management to drive future growth. The company's net income has experienced a significant decline over the past year. Specifically, it decreased by 32% for the year-to-date period of 2026 compared to the same period in 2025, and by 35% for the 9 months ended February 28, 2026. This downward trend is also reflected in the net income margins, which have dropped from 8.5% to 5.8% over the same period. The reasons behind this decline are multifaceted. One contributing factor is the decrease in net foreign currency adjustments, which has had a negative impact on the company's financials. Additionally, higher tariffs in North America and unfavorable changes in standard foreign currency exchange rates have also played a role. Furthermore, the company has incurred increased impairment and other expenses, including brand and marketplace reset costs, employee severance costs, and higher inventory obsolescence reserves. The decline in profit margins is particularly notable, with a contraction of 970 basis points over the 9 months ended February 28, 2026. This significant decrease suggests that the company's profitability has been severely impacted by these various factors. Overall, the data indicates a challenging financial landscape for the company, with net income and profit margins experiencing substantial declines. The company's financial performance indicates a healthy trend in its ability to generate cash from its core operations. A key indicator of this is the positive operating cash flow, which measures the amount of cash generated by the company's business activities. According to the provided information, the company has successfully achieved a positive operating cash flow for 2026, with a significant amount of $1,231 million. This achievement is further confirmed on page 52, where it is explicitly stated that the operating cash flow for 2026 is indeed a positive $1,231 million. The fact that this figure is highlighted as a positive amount suggests that the company's management has successfully optimized its operations to generate sufficient cash from its core business activities. Overall, the company's ability to generate positive operating cash flow is a testament to its financial health and stability. The company's financial health has shown significant improvement in terms of debt levels. A notable reduction is observed in the current portion of long-term debt, which decreased from $999 million to $0 million. Additionally, the overall long-term debt also saw a decline, albeit with some fluctuations, decreasing from $7,961 million to $6,673 million, and then increasing slightly to $7,030 million. While interest expenses are not directly reported, related metrics suggest a decrease in this area as well. This reduction in debt levels and interest expenses is a positive indicator of the company's financial stability and ability to manage its liabilities effectively. Management is outlining a strategic plan to drive the company's future growth. Key strategies include accelerating product innovation, repositioning the Nike brand digital as a full-price platform, and investing in wholesale distribution and demand creation. The company aims to complete these key actions by the end of 2026 with varying financial impacts. In terms of company outlook, management expects negative impacts from Greater China to continue throughout fiscal 2027. However, they are also undertaking a strategic reset of the Converse brand and marketplace, as well as evaluating opportunities for cost realignment to operate more efficiently and profitably. Looking ahead, the long-term goals include achieving sustainable, profitable revenue growth by leading with sport, creating innovative products, and delivering compelling consumer experiences. Management aims to reignite brand momentum and drive long-term shareholder value through product, marketplace, and brand management actions. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts to its investors. For instance, in 2026, it distributed $1,798 million in dividends, while in 2025, this figure stood at $1,709 million. Furthermore, specific quarterly payouts were also noted, with $616 million being returned to shareholders as of February 28, 2026, and $598 million as of May 31, 2025. In addition to dividend payments, the company has also engaged in share buybacks. The financial records show that in 2026, it spent $146 million on buying back shares, while in 2025, this figure was significantly higher at $2,786 million. These transactions demonstrate the company's commitment to returning value to its shareholders through both cash dividends and strategic share repurchases. There are significant concerns about inventory buildup or supply chain disruption affecting the company's operations. High inventory levels in Europe and Greater China have led to negative sales for some products, resulting in a contraction of gross margin due to higher tariffs and lower average selling prices, ASPs. The decrease in wholesale revenues and comparable store sales further exacerbates these issues. The potential recovery of $1 billion in tariffs is uncertain due to a U.S. Supreme Court ruling, adding to the supply chain disruption concerns. Interruptions in data and information technology systems have also increased costs of freight and transportation to meet delivery deadlines. These disruptions are likely to impact the company's ability to manage its inventory levels effectively, leading to further contraction of gross margin. The decrease in inventory obsolescence reserves has led to a gross margin expansion of 300 basis points, but this is offset by the potential for future disruptions in supply chain operations. The overall situation suggests that the company needs to address these concerns to prevent further damage to its profitability and competitiveness. That concludes the financial summary for Nike Inc. Feel free to comment below, and I will be happy to answer them when possible.